If you are managing your own pension, there is one critical mistake you might be making during earnings season, and it will severely damage your retirement. When a stock crashes after an earnings report, the amateur manager does one of two things: panic sells everything, or blindly buys more to average down. Both of these actions will cause permanent damage to your portfolio. In this video, I'll show you exactly how to act during earnings season, and when the most professional decision you can make is to do absolutely nothing. Because an earnings report isn't a casino. It's a structural stress test for your portfolio, and we only act based on a pre-built blueprint. Let's bring order to the chaos. An earnings report shows past results versus market expectations, and more importantly, future guidance. This combination can move a stock by double digits in a single day. The architect's first rule: we do not try to guess the stock's direction. We wait for the market's reaction, and we test it against the specific segment that stock holds in our portfolio. As I showed in my previous video, a retirement portfolio must be divided into segments. Each segment has a different role and strategy. The first segment is the core, the backbone of your portfolio. These are stocks we hold long-term for fundamental reasons. Here, a sharp drop in price is not a reason to sell. We only change our position if there is a fundamental shift in the business itself. In extreme cases, if the stock drops sharply without a fundamental change, just pure market sentiment, we might even increase our position. Conversely, if it surges too fast purely on hype, we execute a mechanical trim. The second segment relevant to earnings is the event segment. Here, we hold stocks waiting for a specific milestone, like a regulatory approval. In this segment, the volatility of an earnings report does not lead to a change in our holding. The only thing that matters is the probability of reaching that milestone. However, in extreme cases of a massive spike or a crash, the architect will use the opportunity to increase or decrease exposure purely for risk management. To summarize, do not act on emotion. Manage your portfolio by segments. Today we touched on just 2 out of the 6 that make up the complete architecture. Remember, in most cases, if your original blueprint is solid, the smartest action you can take is to simply wait. If you want to see the complete breakdown of all 6 portfolio segments and stop making emotional decisions, download the Architect Blueprint in the link below. I'll see you in the next video.